You have probably heard the golden rule for retirement. Save a few $1,000,000, then live off a conservative 4% annual withdrawal. It is the plan most financial advisors hand you when you sit down at their desk, and on paper, it sounds reasonable. The problem is that for most working people, accumulating the capital required to make that withdrawal rate meaningful takes decades. Decades spent inside a career you may or may not actually want, waiting for a number that keeps moving further away as inflation erodes your purchasing power. But there is a more direct path. One where you can generate significant monthly income with a smaller capital base on a shorter timeline, without waiting for traditional retirement age to arrive. That path runs directly through the income ETF space, and specifically through a category of covered call ETFs that meet a very specific set of criteria that most people never apply when evaluating them. Today I am going to walk you through 5 categories of high-yield ETFs that income-oriented investors should be watching closely right now. I filtered through more than 190 covered call ETFs to build this list. The criteria were specific and non-negotiable. Each fund had to pay at least monthly, with a distribution rate of at least 10%, a one-year total return of at least 15%, and, the most important filter of all, positive price returns over the past year. In other words, no Nav erosion. These are not funds that are giving you your own money back dressed up as income. These are funds that are generating real returns on top of the distributions they pay. I will walk through each category in detail, explain the mechanics behind each fund's income generation, discuss the trade-offs honestly, and at the end cover the highest yielding and highest risk category, the single stock niche funds, along with a clear explanation of how they should and should not fit into a real income portfolio. Let's get into it. Before we look at any specific fund, I want to make sure the income math is completely real for you, because the numbers are what actually shift how you think about this. With a $500,000 investment in a traditional Dividend aristocrat-style portfolio yielding approximately 2.67%, you would generate roughly $13,350 per year in income. That is about $1,112 per month, meaningful but unlikely to replace a salary. A high-yielding covered call portfolio with an 11% blended yield on the same $500,000 produces approximately $55,000 per year, $4,583 per month. Now we are having a different conversation. An ultra-high-yield portfolio at 20% on $500,000 produces $100,000 per year, $8,333 per month. That is income independence from a capital base most people could realistically accumulate in a decade or two of disciplined saving. None of these numbers require $10 million. What they do require is selecting the right funds with the right structure, which is exactly what this video is designed to help you do. The framework I use for evaluating any income ETF comes down to 3 questions. First, is it actually earning the income it distributes, or is it slowly returning my principal? Second, does the fund's price hold its value or grow over time, or is the yield being paid at the expense of NAV? And third, is the income generated in a tax-efficient structure, or am I handing a large portion of the headline yield back to the government before I see a dollar? Every fund in today's list passes all 3 of those tests based on the data available at the time of this video. With that framework established, let us go through the 5 categories. Category 1 is the S&P 500 Covered Call ETF, the most foundational layer of a diversified income portfolio. You are getting broad exposure to approximately 500 of the largest U.S. companies, with an option strategy layered on top to convert some of the price appreciation into monthly distributions. The fund that stands out in this category right now is TESPI, the TAP Alpha, SPY Growth and Daily Income ETF. TESPI is still a relatively young fund at approximately 1.5 years old, but it has established a distribution rate of approximately 14.72% annualized, which is one of the highest in the S&P 500 covered call category. The way it achieves this is through a 0 days to expiration or 0 DTE option strategy. Every single morning, TESPI sells options on 100% of its portfolio that expire the same afternoon, typically at or very close to the current price. That daily reset mechanism is what drives the high income. The fund is essentially collecting premium income every single trading day, rather than waiting for a monthly or weekly options cycle. The question most people ask about TESPI immediately is whether that daily reset caps its price appreciation. Technically, it does cap each individual day's upside, since the options expire at or very near current price each morning. But because those caps reset fresh every day, TESPI has still delivered approximately 2% in price appreciation over the past year, while paying its large distributions consistently, including during April 2025, when markets experienced a sharp and painful correction. That combination of income consistency through volatility plus positive price return is exactly what the filter criteria are designed to find. It is worth noting that two other S&P 500 covered call funds, GPIX and SPYI, have delivered stronger total returns in this category at approximately 18.16% and 17.66% respectively since inception, because their option strategies are less aggressive on income extraction and therefore preserve more of the underlying S&P 500's price appreciation. If your priority is maximum total return, those two funds deserve the nod. If your priority is maximum income consistency with an index foundation underneath it, TESPI is the current category leader. Category 2 is the Nasdaq 100 Covered Call ETF, your access to technology, innovation, and the companies most directly exposed to AI, cloud computing, and digital infrastructure growth, but with a monthly income stream generated on top. The steady winner in this category is QQQI, the ENEOS Nasdaq 100 High Income ETF. QQQI was awarded Best New Active ETF at the 2025 ETF.com Awards, which is meaningful independent recognition in a crowded space. Its current distribution rate is approximately 14.11%, and it has delivered approximately 5.45% in positive price return over the past year, satisfying the Nav Erosion filter. QQQI's approach differs from most Nasdaq 100 covered call funds in one structurally important way. It writes options directly against the Nasdaq 100 index itself using NDX options, which are Section 1256 contracts. That means 60% of the options income is automatically taxed at the lower long-term capital gains rate and only 40% at the short-term rate, regardless of how long the fund has held the position. For investors in a taxable brokerage account, that tax treatment alone can be worth 5 to 10 percentage points of effective after-tax yield compared to ETFs, generating equivalent income through ordinary income treatment. QQQI also actively manages its overlay, writing calls on approximately 75 to 90% of the portfolio rather than 100%, which preserves some upside participation when the Nasdaq rallies strongly, contributing to the positive price return even while paying the high yield. It is also worth acknowledging three other Nasdaq 100 funds that pass the same screening criteria: GPIQ from Goldman Sachs, GEPQ from JP Morgan, and QQA. GPIQ is worth particular attention if you are looking to balance income with meaningful tax deferral. Its use of return of capital distributions allows investors to defer taxes on a portion of income until they sell, potentially at lower long-term rates. JEPQ and QQA use equity-linked notes for their options exposure, which makes their income ordinary income for tax purposes. In a Roth IRA or similar tax-advantaged account, that distinction disappears completely, making GPQ and QQA more competitive on an after-tax basis in that specific wrapper. In a taxable brokerage account, QQQI and GPIQ remain more tax-efficient. Category 3 is the Russell 2000 Covered Call ETF, and this is the category where the macro context makes the selection particularly interesting right now. Small-cap companies make up the Russell 2000 index, and their performance over the past several years has been meaningfully suppressed relative to large-cap technology stocks by one specific factor: interest rates. Small companies rely heavily on floating-rate borrowing to fund operations and growth. When rates are high, their interest expenses rise directly, and their profit margins compress. When rates decline, the relief flows through to their balance sheets immediately and predictably. That means small-cap stocks are among the most directly and immediately sensitive to Federal Reserve rate decisions of any asset class in the broad equity market. The valuations of small-cap stocks today reflect years of underperformance versus mega-cap technology, which means they are entering any rate-declining environment at significantly cheaper valuations than they would normally occupy. That combination, rate sensitivity plus valuation discount, creates elevated volatility. And elevated volatility means higher option premiums, which means more income potential for a covered call strategy layered on top. The fund capturing this opportunity is IWMI, the NEOS Russell 2000 High Income ETF. IWMI holds the Vanguard Russell 2000 ETF as its core and overlays a tax-efficient out-of-the-money covered call strategy on top. Its current distribution rate is approximately 14.69% based on its most recent $0.60 per share monthly distribution. And consistent with the NEOS approach, the fund prioritizes capturing upside when the underlying assets rally. IWMI delivered approximately 8.53% in positive price return over the past year while paying that distribution. For investors who want to build a diversified income portfolio that does not depend entirely on the continued dominance of large-cap technology, IWMI offers a genuinely differentiated exposure. It draws from a completely different pool of companies than VOO, QQQ, or any of the S&P 500 and NASDAQ 100 covered call funds, providing real diversification of economic exposure, not just superficial diversification between funds that ultimately own many of the same megacap positions. Category 4 is alternative assets, and specifically gold, which has become one of the most discussed topics in income investing circles over the past year for obvious reasons. Gold has increased in price by approximately 76% over the past year, driven by a combination of geopolitical uncertainty, dollar weakness concerns, central bank buying, and inflation hedging demand from institutional investors worldwide. And the fund that has turned that extraordinary gold move into extraordinary income is IGLD, the FTGF Gold Strategy Target Income ETF. IGLD currently carries a distribution rate of approximately 21% as of its early March distribution and has delivered approximately 41.82% in positive price appreciation over the past year. Both of those numbers look almost too good to be true, so let me explain the mechanics carefully, because they are genuinely interesting. IGLD does not actually hold physical gold bars. Instead, it uses a synthetic strategy, combining long call options and short put options on GLD, the SPDR Gold ETF, to replicate gold's price movement almost exactly while simultaneously freeing up the fund's cash. That cash is invested in short-term U.S. Treasuries, adding an additional layer of interest income on top of the gold price exposure. Then IGLD sells covered calls against the synthetic gold position to harvest premium income, using what is called a target income approach. The managers aim each month to generate a yield approximately 3.85% above the current one-month Treasury bill rate. Because gold's implied volatility has been elevated over the past year, the premiums generated have been correspondingly high. The most important structural feature of IGLD for growth-conscious investors is its partial overwrite approach. In a strong gold bull market like the past 12 months, IGLD leaves a portion of the fund's position uncovered, meaning it does not write calls against every dollar of gold exposure. That uncovered portion participates fully in gold's price appreciation, which is why the NAV has risen substantially even while paying a 21% distribution. I want to be honest about expectations going forward. This level of distribution is not sustainable indefinitely. It is a product of elevated gold volatility that may moderate as the market normalizes. But IGLD's structure is genuinely designed to generate consistent income over the long term. The target income approach means it adjusts its option writing as conditions change to maintain a durable, sustainable payout, rather than maximizing yield in any given month at the expense of the next. Category 5 is the high-octane niche, the single-sector and single-stock covered call ETFs that generate the most extreme headline yields in the income ETF universe. Funds like GDXY, SOXX options funds, BIGY, and single-stock names like GUI operate on a common engine. They use a synthetic option strategy to create a long position in a specific underlying asset and then harvest income by selling covered calls against that exposure. The income potential in this category is genuinely extraordinary. GDXY, which focuses on gold mining companies, currently carries a distribution rate over 100% annually. GUI, which focuses solely on Google, generates approximately 39%. More moderate niche funds targeting the semiconductor sector or the top 50 U.S. companies at a specific 12% target income yield represent the less extreme end of this category. The income numbers are real. But the trade-off is also real and must be understood with absolute clarity before any capital is committed to these funds. Every dollar you allocate to a single stock or single sector income fund is a dollar whose income stream depends entirely on one company or one slice of one industry performing reasonably well. If Google has a catastrophic regulatory year, or if a specific sector enters a prolonged downturn, your distributions drop and your NAV gets compressed simultaneously. You are experiencing both reduced income and capital loss at exactly the same moment, which is the worst possible combination for an investor who is depending on that income. This is fundamentally different from what happens when a broadly diversified fund like QQQI or TESPI goes through a difficult period. The broad diversification means that some holdings are always working, while others are struggling, providing a natural income buffer. The honest framework for these niche funds is this. They belong only in a satellite role within an already diversified income portfolio. Think of them as yield kickers. A small allocation, typically 5 to 15% of total income exposure, that boosts the blended yield of the overall portfolio without making the entire income stream dependent on one company's performance. If you are 100% in GUI and Google has a terrible year, you have no other income engine running. If GUI represents 10% of a portfolio, that is 60% in TESPI and QQQI with IWMI and IGLD providing additional diversification, and Google has a terrible year, the rest of your portfolio continues delivering income while the Google position recovers. That is the right way to use these funds. They are not replacements for a core diversified foundation. They are additions to it. Let me bring all 5 categories together into a coherent picture of how a genuine income replacement portfolio might be structured. The foundational layer, probably 40 to 50% of total income allocation, should be the broad index-covered call funds, TESPI or SPYI or GPX for S&P 500 exposure, and QQQI or GPIQ for NASDAQ 100 exposure. These give you the most diversified underlying equity exposure, the most established track records for income consistency, and the best tax efficiency. A meaningful secondary layer, perhaps 20 to 30%, can go to diversifying income sources like IWMI for small cap exposure and IGLD for gold and real asset exposure. These reduce your dependence on large cap technology dominance and add genuine non-correlation to the income stream. And a tactical satellite layer, 10 to 20% maximum, can include the niche single sector or single stock funds for yield enhancement, with the explicit understanding that these positions carry concentration risk and should be sized accordingly. The overall portfolio built from these 5 categories can realistically target a blended yield of 13 to 16% annually, depending on allocation choices and prevailing market conditions, while meeting the Nav Erosion criteria that separate genuine income from return of capital disguised as yield. On a $500,000 investment, that blended yield generates $65,000 to $80,000 per year in monthly distributions. That is a meaningful income replacement for a large portion of the working population. On $300,000, it produces $39,000 to $48,000, a significant supplement to other retirement income sources like Social Security. The point is not that you need to start with a large portfolio. The point is that the mathematics of a well-constructed high-yield covered call portfolio are fundamentally different from the mathematics of the traditional dividend aristocrat or the 4% withdrawal rule. and understanding those mechanics opens up timelines and possibilities that most people have never seriously considered. Before I close, one principle that I think is worth stating clearly. The fund universe in this space is changing faster than almost any other area of ETF investing. There are now more than 80 covered call ETFs listed in the United States, and new launches are happening constantly. Some are genuinely innovative structures like the ones we discussed today. Others are dressed-up yield traps that look attractive on the surface, but are quietly returning capital and eroding NAV, while advertising eye-catching distribution rates. The framework in this video: minimum 10% distribution rate, minimum 15% one-year total return, positive price appreciation, and a clear understanding of the option strategy mechanics, gives you the filter you need to separate the genuine opportunities from the noise. Apply it consistently, and you will make significantly better decisions than the average income investor chasing the highest yield number without asking what is generating it. If this breakdown was useful and gave you a more structured way to think about income ETF selection, hit the like button and subscribe. I cover income ETFs, portfolio construction, and covered call strategies in depth with new content every week. Drop a comment below with the specific category you are most interested in exploring further, and I will prioritize the most requested ones for upcoming videos. I will see you in the next one.